Good evening and welcome to the weekend edition. My name is Peter Reznicek from ShadowTrader.net. I'm the only show that tells you exactly what is really going on. You probably watch other shows similar to this during the week, but honestly, those are a lot of photogenic people that are just regurgitating fundamental information, and that's not going to tell you anything about the market. This is the type of show that you need to be watching because it is technically focused, and that is what is really going on. Because remember, the charts and only the charts are the footprints of money. Lots to talk about this week. We have our usual what's really going on. We're going to get into a little bit of market profile this week. I promised you those dark backgrounds on the profiles. I have that for you. And I've got some trade ideas for you that are going to be interesting, I think, that are specific to the type of market that we are in. All right, all that and much more on today's weekend edition. Okay, let's rock and roll. Starting, of course, as we always do, with the weekend review so we can get an idea of what went on in the markets and what were some of the drivers of that price action. I call those the ruling reasons, as always. So our ruling reasons this week were quite myriad, I would say. It was kind of a newsy week. I thought there was a lot going on. On Monday, kind of kicked things off with some bullishness in semiconductors. That whole space gapped up and sort of set the tone for the week, if you will. There was a little bit of buzz in the AI space on Tuesday when NVIDIA launched a new product at the CES. Thursday and Friday is when things got a little bit hot and heavy. First of all, there was defense stocks rallying on POTUS desire to up defense spending. That was on Thursday. And also continuing claims on the jobs report front came in up about 56,000. So that labor market still continues to be soft a bit, right? It's still not the greatest news coming from the labor market. On Friday, the unemployment rate did tick down a bit. That's interesting because we've been watching that very closely. Remember, we were sitting at 4.3 for a long time, then ticked up a little bit, went up to 4.6 last month, came back down to 4.4, and also the Supreme Court did not rule on Friday on the legality of the tariffs. All traders, myself included, we're kind of on the edge of our seat on Friday morning because at 10 a.m. Eastern was supposed to be the opinion, but they ended up ruling on another case. And the next day that they will be giving an opinion again is going to be January 14th. So remember that. That's going to be important. We have no way of knowing, however, if they are going to rule on the tariff case, but that's going to be the next date when they could potentially be ruling on the legality of the tariffs. So keep that in mind. All right, let's look at some numbers here. Starting from the upper left, as always, everything pretty much bullish all week. Russell was the biggest winner, but NASDAQ and S&P both up about 1%. Remember, everything on the page is always measured from Monday's open to Friday's close because unlike those other shows, we are only interested in what we can actually make money from, right? So it was that open on Monday, close on Friday. All right, 11 sectors. Everything was pretty good, but the same theme of divergence continues. I don't want to get into it too deep on the show because we've been talking about it for the last 2 or 3 shows, but just keep it in mind. It's still a thing because look what technology did over the course of the week. From Monday to Friday, all that bullish action that you see here in the top line figures in the S&P, NASDAQ, etc. But at the end of the week, from Monday's open to Friday's close, XLK and tech stocks literally ended up about that much, 0.1%. All right, financials were much better off. Healthcare, discretionary, industrials, communications, all this stuff heavily green. And you can see right here, this is how you know it was more of a bullish week as the defensive stuff backs off a little bit. Energy and utilities down. Materials absolutely killed it because that includes gold, and mining stocks are very strong and gold was very strong. All right, over to the right side. Bonds and yields, not much of a change. VIX continues to collapse. 14 is a relatively low number, but it can get even lower. We're not at that level yet of like VIX 11, VIX 12, where we got to be looking at that and thinking, you know what? This is where the market could come down because this volatility is just so in the dumps. All right, gold, as I said, had a great week, roared back to the 4,500 level, not too far away now at this point from the all-time high. We're almost there, somewhere in the 45s. Crude had a decent week, up about 2%, and Bitcoin is still languishing around 90. Remember, the swing low was around 82, 83-ish, and I was saying that 95 is a trigger, and guess what? It did, and it fell right back down. I actually lost some money on that this week because I did buy those Bitcoin futures at that 95 breakout, and it went right up to that level. I thought we were going to push higher and then spent the next 3 days going right back to 90. So this gives you a lot of market generated information. When you look at that price action in Bitcoin, it is clearly telling you that nobody cares right now, and you really need to get stronger and hold stronger, because with cryptos, the only thing that matters is higher prices. Higher prices beget even higher prices, and that's the only thing that seems to keep people interested, right? So that, my friends, is our weekend review. On to the real meat of the show, as I like to call it, what's really going on, breaking down the technicals in the S&P and NASDAQ 100. Let's take a look at the S&P first, starting with the daily. The wedge pattern that I talked about last week is basically still in play, but we started to break out of it. You can see here, right, on the Friday close, we pushed up above that wedge. There's a couple of things I would look at in this chart that I would sort of take to heart over the next week or so. One, you never got a pinch here. That's bullish sign. The spread here between the 8 and the 21 EMAs is wide and is holding. That's good. That's more bullish. If they're close, it's less bullish. Tells us the market's chopping a little more. So the fact that that 8 is pulling away from the 21 is decent. You broke out of the wedge to the upside. That's a bullish sign. And then last but not least, you've got a 7,000 psychological round number in the cash market above you. That's important. Remember, don't worry about the futures market. What matters is what the cash market does, and the cash market has not yet hit that 7,000 benchmark yet, that goal up there. And usually when you get that close to a big round number, big psychological level, the market's not really going to sell until it gets there. So watch to see closely next week. If we touch that 7,000, probably pause a little bit there as we digest it, but it's going to be an important level, and I think that's where the S&P is probably going to go at least. All right, let's take a look at the NASDAQ. Here's where things get really interesting, and it absolutely speaks to that divergence that I've been talking about. Look at the difference in this chart in terms of where the highs are, going all the way back to here, where the highs are and where current price is, right? You know, the S&P already at the all-time high, pushing higher, and this is still stumbling. I have marked off a few important points here, right around this 25,000 area, right in here, up in here. Okay, this I think is important. 25,766 is where we closed, right in here, and I put the line right above it. And these arrows just represent days where you resisted at the exact same level. So look, 1, 2, 3, 4 arrows, and I purposely put a little question mark there, which is the 5th one. It's probably going to break, right? You can't knock on a door that many times and not break it. But the main takeaway from this chart is the relative weakness. And I don't know yet if this is going to be a problem, but the purpose of this show is to alert you to things that can help you and also alert you to things that might someday hurt you. And that's really important. So is this divergence or lagging in the tech stocks, lagging in the NDX going to be a problem for the market in Q1? We shall see. So continue to monitor this closely. It's healthier if all the indices are running together, all right? We talked a little bit about those 8s and 21s earlier when we looked at the S&P chart, and I said that that 8 and 21 in the S&P is spread out, which is a bullish sign. But look at the NASDAQ, how close it is. Here you almost touch, and here you can see it's very, very close. So you know what your key levels are going to be. You want to be watching that 25,766 area. Call it about 25,800. Right? 25,766 is where we close, right about where the tops of these candles are. So call it like 25,800. That's going to be your key level in the NASDAQ next week. What you want to be watching for is a break, but you don't want to see what I call a look above and fail. Look above and fail is when there's a balance area denoted by multiple highs. Look above and fail is breaking above balance, coming back into balance. Remember, if that happens, the rule states that if you break above balance, you can fall back down to the opposing end of balance, and you could be here. If that 25,400 level in the NDX ever gets tested at all, meaning we would go there, this market is probably going down, right? This is a lot of congestion here, a lot of pressure built up, and that pressure right now needs to break to the upside relatively soon. And if it doesn't, like I said, you're going to break the uptrend and you're going to be back down here below the 821, all right? So you've got major key levels in your NDX to be watching for next week. And again, pay attention to that divergence because it could be an issue in this year. Following on with what we were just discussing about the NASDAQ 100 relative weakness, let's do a sector spotlight this week just on the XLK, which of course is technology. And it's twofold really what I want to share with you. Obviously, this is just sort of a title card. 34.4% of the S&P is the new weight, which just got changed on December 31st. Always at the last day of each month is when they officially change the weights on the S&P global website. And I want you to pay attention to this because these are the top 10 stocks here. So look at some of these names: NVIDIA, Microsoft, Apple, Broadcom, Palantir, Oracle, etc. Keep those in mind for potential trade ideas, or to be honest with you, potentially stocks to stay away from. And you'll know why in a second. Let's take a look at the chart here. Look at the XLK. This is the XLK on a daily. Now, remember, everything is contextual. It's a very bullish week, or rather it was a bullish week, right? S&P and NASDAQ both up 1% on the week. Not bad, right? Russell up a bit more. So in the context of a bullish week, we already established that the XLK didn't even move. So graphical representation of that, of course, is the chart. Look at all these sessions and how much pressure is building up. It didn't even move. This is why when we did the weekend review, we clearly showed that from Monday to Friday's close, the XLK actually moved up 0.1%. Why? Well, that's it right there. It literally hasn't moved. That 8 and 21 are going dead sideways, and it's bubbling under this trend line, right? You got a downtrend line in place, way away from the all-time high, but most importantly, hasn't even broke the downtrend. So I like to give you news you can use to make money, and I like to give you news that you can use to not lose money. And right now, technology is not the place to be, basically, all right? There's other sectors out there that are really moving: financials, consumer discretionary, etc. This is where the action is, but it's basically not in tech. But it's very, very important to know this information because at the end of the day, all of this is almost 35% of the S&P, okay? It is the market. Those of you who follow ShadowTrader closely, if you're in my trading room every day, you know that we've got all these market internals up on the screen all the time. We're always watching context like a hawk. We got our sector boxes. We got our weighted AD indicator. All of that stuff is showing us at a moment's notice how strong the sectors are from the open of that day. And we know from experience that it is very hard for the market to move against XLK. It's really hard. As technology goes, so goes the market. So I think it's very, very noteworthy. A lot of market generated information right here. The fact that this XLK is clearly lagging. So keep an eye on this next week, and also those 10 stocks that are the heavyweights in this sector. Let's do a little market profile. Obviously, subject very near and dear to my heart. As I promised you in the last episode, I got some dark background charts for you that I think you'll be able to see the distributions a little bit better. Just want to point out a couple of things in the market profile, not getting too deep in it. Obviously, this is a subject that is very deep, very wide. We can go on and on forever, but you got to start with some basics. So let's just look at this distribution here of this particular week. I'm keeping it super simple. Basically, the last 5 days of the week, yellow areas are value. And you can kind of use this information to give you an idea of how strong things are. So basically, do you see anywhere in these charts that there is the yellow area broken away from the other areas and not overlapping? The answer, of course, is no. Notice that the yellow areas are all overlapping, and here they're all kind of equal, right? You kind of go back and forth, and that's the sign of all of that sector divergence in the S&P, causing the ES, because obviously these are market profiles of the S&P E-mini futures, causing the ES to have all this backing and filling. And Friday, finally, it pushes up out of that area a little bit, and you get a little bit of expansion of range, and also you finally get that value area pushing up over that 7,000 level. So what am I getting from this? What is the main takeaway? Is that yes, the market's bullish, but it's just very slow and grindy, right? I was having this exact same discussion today in my trading room with all my subscribers, and I literally asked everybody how they felt about it. Do they feel really bullish right now, or is it more cautiously bullish? And pretty much everybody answered that they only feel cautiously bullish, and that's kind of how I feel. And the profile is certainly showing us that, all right? This one over here on the right is a little bit different. I've put what we call a composite profile, where I take the volume at each price level and sort of flip it on its side and have the histograms running up and down. Now, first things first, there's a little bit of a mistake, actually. I apologize when I put this together. There is an extra distribution here. There's actually 6 days instead of 5. I wanted to make this match up, but my fault. I was kind of hurrying. So obviously there is that extra day that is distorting it a little bit in terms of volume. But even that actually helps the picture a little bit, because notice that these two areas are relatively similar. What I wanted to point out on this basically is that the volume dried up a little, right? You see how the futures volume is not really as strong up at the highs, and most of it is kind of coagulating down here around these levels. So as far as futures are concerned, if we are to come in a little bit next week, these are the areas that you want to be watching very closely. This is 69.88, and this one down here is 69.61.75. Now, it doesn't have to be exact. It's more like an area, but remember that the basic way that markets work is they only do two things. They're either in balance or they're in excess. Balance is when they're balancing, prices are just going back and forth. That's an efficient market because it is distributing a high number of futures contracts to the greatest number of players. Excess is when it pushes out of that balance area and then tries to establish some sort of balance at another price level. Could be higher, could be lower, right? So markets will always push, pull, expand, and contract from areas of higher volume to areas of lower volume. In those lower volume areas, markets are less comfortable. In higher volume areas, markets are more comfortable, and they tend to be pulled towards those areas. So kind of granular, but important, especially if you're an active trader. If we come in a little bit next week, watch these high volume nodes, meaning can we get above 7,004.25 roughly and find acceptance next week? That's going to be important. Keep that level in mind in the ES. Below you, 69.88 and 69.61.75. Those are your high volume nodes there. Any weakness in the market will be pulled to those levels like a magnet, and then if you start to cross those levels to the downside, that volume flips and then becomes overhead supply. Also, gentle reminder, shameless plug if you will, the Market Profile course is live. If you like this sort of analysis, trust me when I say it gets way deeper. It's endless. The amount of different ways you can slice and dice Market Profile and get more and more market generated information out of it and get more and more granular and have even more of a clearer picture every single day of what the market is actually doing. So check this out. It's live on our website right now. This is a little teaser video that I put together. The entire course is 8 hours long, but I just chopped up kind of like a sample reel for you. This is on our website. The link is in the description below if you want to check that out. Let's get a little more specific as to what is going on currently, what you should be doing, or more importantly, what am I doing? I want to show you something right here. This is just a quick snapshot I took today, a couple of trades that I'm involved in. And the reason I wanted to show this specifically is I think that it kind of drives the point home of how I feel about the market and what I'm doing. Firstly, I'm not super aggressive right now. I'm keeping size small. I don't really trust this market right now. Feels very grindy to the upside, and I'm focusing more on the gold trade, right? I've been talking about the gold trade a lot in my room. This one you have to be part of my trading room to understand. I will teach it to you there, but that's actually a typical average day, to be honest with you. $5,000 to $10,000 to $15,000 a day. That gold trade continues to pay off. I've been talking about this for months and months, and it continues to pay off really well. It did really well this week as well. Beyond that, what did I write here? Be net short calls in this environment. That's always my MO anyway, right? I like to trade directionally at little to zero debit. This is what I teach people in my trading room. I've been doing it for many years. Been successful, always at the high watermark for profits, almost every single month since we started. And that's the proof that it works, right? The proof is in the pudding. You're either making money or you're not, and this stuff works. So what I like to do, especially in an environment like this, where the market is grinding to the upside, and I don't really have fear that we're going to explode big to the upside, right? And I also know that tech stocks are a little bit lagging. I'm going to be looking at those names, and I'm going to be buying complex spreads where I am net short calls, meaning buy one, sell two, buy one, sell three, unbalanced butterfly, broken wing butterfly, right? All of those things are situations where you are net short calls and can be placing trades for a credit or a tiny debit or free, right? That's the thing. So for example, Amazon, right? I've circled this here. This is a situation where I'm long 247 calls and I'm short 260 calls. I'll show you a chart in a second so you'll understand this better. But basically, I put a box right here around the value of the calls when they were sold, average of about 43 cents, okay? So the thought process is that you're looking for stuff that you believe is overvalued because of where it is on the chart. You're not using delta or anything like that, saying, oh, well, I'm just selling this call that's 5 delta or 10 delta or whatever. That's asinine, to be honest with you. That has nothing to do with anything. You need to be looking at where calls are that you feel are mispriced because they are above technical levels or at technical levels where there's going to be resistance. And the only reason that there's probably juice, if you will, in those calls at any time is because that stock moved up aggressively or had like a bullish day. So Amazon is a good example of that. In this case, long the 247.50 call and short 2 times the 260 calls, right? Tesla is another good example. Basically looking at spreads where trying to get long around 475, 480, 482, but financing that with sales of 500 calls, and you can see the box here around 30 cents. And I know these are cheap calls. This can work in all different environments where you may be selling the out of money call sometimes for $4, right? Sometimes it's under 50 cents like this. It doesn't matter because the theory is the same and it works the same way. You want to be looking for opportunities where that stock pushes on one day, has a very strong day, but at the same time is very, very far away from that resistance. And again, the only reason that there's value pushed into those calls is because that stock was having a good day. That value should be collapsing and then your spreads expand. Let's take a look at the charts right here, just so you understand the why this is done and what the technical level here is. In the Amazon chart, notice that I started here at 260, drew the arrow all the way across. Why? Because that's resistance. So it makes sense. So you'll be setting up spreads that are going in that direction using 260 calls short, but long calls underneath it. Tesla, same thing basically, right? This one I think is even better. Notice where I drew the 500 here. It's above resistance, but more importantly, above the consolidation, right? This is important. Look at all this consolidation. Is Tesla on a rally going to be able to go higher and push through this without pausing, especially when the expiry is 7 calendar days from today? I don't think so. So that 500 call up there that is only 30 cents makes a whole lot of sense, okay? A lot of amateurs will look at this whole thing and the first thing they will say, and I've heard this a million times, okay, is like, why are you picking up pennies in front of a bulldozer, blah, 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 or why would you put on that much risk, to get this 30 cents or whatever? The reason is because the odds of getting the 30 cents are like 95%. That's the point. Okay, and if you did that every day, if you really did the math and you figured out how much cash outlay, or I should say buying power reduction, you actually are putting on the line, you would see that you would probably be making a 100% return at the end of the year if you did this every single week. But that's not the point. I'm just trying to sort of play devil's advocate to the people that always say that. When you are using net short calls or naked puts, in a very technical manner, when you are placing them strategically beyond resistance points, beyond levels of congestion, that's where this type of trading makes the most type of sense. It doesn't make sense when you just look at the options chain, you have no idea what the movement of the stock is, and you just say, I'm going to sell the 30 delta call and bring in some premium. Or, I'll sell a call vertical there. That makes absolutely no sense. That 30 delta call is probably going to be somewhere in here at like 472 or whatever, and you're probably going to get run over, okay? So this is how I trade. This is how I've been trading for years. I've been successful with this for years, and I purposely wanted to bring this to your attention on this particular exact show because this is exactly the type of strategic thinking that works well in this type of environment. When the charts are a little bit cleaner, when you do not have divergence in every single sector, when you have technology leading, you will be doing strategies that are more akin to what I call risk reversal, right? In those situations, I sell puts naked, I take the money, and I buy call verticals. I don't do complex spreads. I do a spread that's going to actually make money when it goes up, right? It's harder to do that with a butterfly or net short. So you want to be buying a call vertical or buying single calls, but at the same time, being confident of the levels below you at your support levels so that you can sell puts on pullback days to finance those calls. Because remember, the number one thing that's going to keep you successful in the options market is always going to be location, 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 meaning where do you start the trade, but also more importantly, what is your cost profile? And that's what I teach every single day in my trading room. And I've been doing this successfully for many, many years because I start as much as I can from a cost of zero, because you are never always going to be right on direction. I am wrong just as many times as anybody else, right? If you can hit 60% in this game, you're a genius, right? Those 40% of the time when you're wrong on direction, you want to be in a spread that costs you nothing so that that trade is a break even as opposed to being put in the loss column, right? So this stuff works over time. I teach this every day in my room. If you want to join me, hit the link in the description below. All right, let's wrap it up with a little bit of looking ahead so we can get an idea of what we might be encountering next week. A little bit of economic data, but also more importantly, Q4 earnings. We're going to start a whole other season, whole new season, I should say, and that always starts with banks and financials. You can see that right here starting on Monday with JP Morgan. So bank and financial earnings next week is going to kick off the new season of Q4 earnings. On the economic front, there is some inflation data coming on Tuesday and Wednesday, so pay attention to that. Obviously, CPI and PPI, those are the Fed's preferred measures of inflation. They watch that very closely to figure out what they're going to do as far as rates. On Tuesday, we're getting a whole more slew of bank earnings, Bank of America, Citigroup, and Wells Fargo, and then that continues on into the end of the week with Goldman Sachs and Morgan Stanley, and of course, the usual labor data on Thursday, all right? So that is our looking ahead for next week. And that's our show for this week. Thank you so much, as always, for spending a little bit of your weekend with me. Remember, if you could, please hit the like and subscribe buttons and also the bell icon to be notified whenever ShadowTrader posts new content, which is, of course, every day through our Shadow Shorts program. All right, let's recap a little bit of what we talked about because we covered a lot of topics in this show. Most importantly, I think, in terms of a technical takeaway, is all about that NASDAQ 100 weakness. Next week is going to be pivotal to see if the NASDAQ can finally get some legs, break out of that box that I showed you, which is also going to break its downtrend and start moving towards its all-time high, which the S&P has already done. We've been talking about divergence on this program for the last 3 or 4 weeks a lot because it is exactly what's really going on. And that's, of course, the purpose of this show, is to break things down from a technical manner, forget about all that fundamental mumbo-jumbo, and just talk about price action, which is all that really matters because, as market profile theory teaches us so well, price and value don't always walk hand in hand on the same side of the street. They don't. Oftentimes they are very, very divergent. And that, of course, can be a problem and kind of trip people up. All right. Beyond that, structure that I talked about, meaning option structure. Do what you can to try to place trades at no debit if you can. Be net short calls in this environment. Why? Because the market is moving up, but the market is also moving up in sort of a slow grinding manner. And that's the best situation where some premium is being pushed into those calls, but you have less odds, or chance, I should say, of being run over by a strong market that's going to go through them. All right. So keep all of that in mind. These are the topics and specific theory and also live trades that I keep track of for many, many years, full track record. This is what I do day in, day out in my trading room. Hit the link in the description below if you'd like to join me, all right? On behalf of myself and the whole ShadowTrader team, I wish you good trading and good night.